Well, we saw the unemployment rate yesterday in Australia defying cooling economic conditions, edging down to 5% in December. Here to take us through what this means for the economy and specifically the RBA's rate trajectory. Very pleased to welcome Tony Sacre, CEO of the Bentleys Network, who's live in the studio with us this afternoon.
Hello.
Tony, thanks so much for joining us.
Pleasure. Nice
Let's talk a bit more about that number that we saw yesterday. As I mentioned, falling back to 5%. The labour market seems to be withstanding the plunge in property prices that obviously is threatening consumer spending. Part-time versus full-time jobs was such a fascinating part of that release. What did you make of it?
Yeah, look, that's exactly right. You know, firstly, it's a really good number from the RBA's perspective because you're right. They've got a weakening housing market, weakening business lending. Heading into election, there's a reduction in capex across corporate Australia anyway. So these would all be concerns. So the last thing the Reserve Bank wanted to see was unemployment 5.5% or something like that. So there's still liquidity in the market. People have got jobs to fund the debt. But you're quite right. If you look at the split, the unemployment rate is back at 5%, but the underemployed rate is still something we do need to focus on as an economy. It did improve a bit in this quarter, which is good. But what it really means from a microeconomic perspective is two things. One, if you look at the underemployment that is out there in the market, those people that are in the gig economy, if you will, you know, they've got part-time jobs here and there, or they're working for startups, so they're underemployed. That has a real impact on the economic and social welfare of Australia, which is one of the key requirements for the Reserve Bank. You know, so they want to see that start to improve and see people putting money aside for their superannuation, which contractors typically don't get the opportunity to do all the time. So that's quite an important facet. Also, if you think about the fact that the employment level itself is really strong, that additional impost into the market will allow the Reserve Bank to have a little bit of time and to, I guess, take a breather regarding what it's going to do with interest rates as we're heading in, obviously, to an election.
I want to ask you about the Reserve Bank in just a moment, but the wage crisis as well, as Labor has described it. I mean, we consider that headline figure that, as you say, looked very good.
Yes.
The fact that full-time work, though, is not out there, that is concerning. Wages are not increasing either.
No.
All of these factors, I guess, concerning more broadly for the Australian economy and our growth outlook.
That's exactly right, and the concern as I look at it for me isn't so much on the wage side. The way I look at it is actually the impact that it has on the SME sector in Australia. You know, that's a real engine for the underlying economy. I think a lot of people get focused on, you know, the banks and the resources stocks, but it's the SMEs that make up such a part of this economy. And when you've got unemployment at 5%, it's very difficult to find work. So a lot of these folks in the SME sector really have to focus on how they're going to try and attract employees to come into the market. So it might be in such matters as making sure that their employees are adequately trained and have good career development progression, because it's tricky, I can tell you, it's tricky to find staff and it's tricky to retain staff. So in this market, that is a concern for the SME. But yes, I understand Labor's view that they're very much concerned about as wages growth starts to spiral out of control. But I don't think we're seeing it as yet. And so that, I do not think, will be a concern for the Reserve Bank as certainly we head into the next 6 months. So I think rates will be stable.
The Reserve Bank meeting, not next week, but the following Tuesday, so we are edging closer. It will be their first meeting, of course, for the new year. And I just wonder what their rhetoric might be. Outside of this Labor print that we saw yesterday, a lot of the figures recently on the economy have been on the softer side of things. They seem to be reluctant rate cutters, though. Their rhetoric seems to be the next move in interest rates is up. What are you expecting at that meeting, and how do you think that Labor figure from yesterday might feed into how they're viewing things right now?
Yeah, look, as I said, I think it's absolutely a breath of fresh air for them. You know, I think if the Labor figure went the other way, I think it really would have been difficult for them to not make at least an announcement at the meeting that they might be looking at cutting rates in the future. I never thought they were going to cut in February at all. But what I think you will start to see is, obviously we've got CPI out next week as well. I don't expect that to be a dramatically strong number either. So I think you'll see the Reserve Bank, you know, that meeting in February, look back at what CPI is. I expect it'll be 0.3, 0.4, something like that on the quarter, 1.6 over the year. So it's under that 2 to 3% window, of course, that the RBA focus on for where they think should be equitable growth within the Aussie market. So I think what you'll see in February is them coming out probably just being very cautious heading into the year, but that's not what futures markets tell us. Futures markets do tell us that there's a very good chance of a rate cut later in the year,
yes.
a good 50%. I think a 50% chance of a cut.
Yep.
I think with the election coming up, I think the Reserve Bank would be very hesitant to do anything because that would be seen to be political one way or the other, and obviously they very much value their own independence. So I don't really think that there'll be any rate cuts, certainly before the election. And I guess what they're hoping for is post-election, some of this pent-up demand that we've seen leading into the election to actually get released post-election, almost regardless of who wins the election realistically. And that then helps to stimulate wages a little bit more, makes the housing sector come up a little bit, business lending becomes a little bit stronger, and a bit more capital is released.
Sure, so things being stimulated, I guess, again after the election. So you think that they are pretty comfortable just sitting on their hands, sitting tight for now?
I don't know if comfortable is the right word, but I think they will sit on their hands.
They won't move.
Yeah, exactly. Yeah.
Look, I'm interested in your thoughts as well around the banks and how that's feeding into it, because we heard from the NAB just yesterday, the latest of the banks to move and hiking their variable mortgage rates. And
yes.
Sure, you saw that, and looking at the ramifications certainly for the SME sector as well.
Yes.
You just wonder whether that relieves some pressure for the RBA in any respect, meaning that they sort of don't need to do anything because the banks in many ways are doing the heavy lifting for them.
To an extent, but I think what you do see very different from maybe 10 years ago was when the Reserve Bank would act to an interest rate change. The banks would usually pass that on quite quickly, whereas now I think one of the concerns is any interest rate change that would be passed on to the banking sector. The banking sector may hang on to that rate change for a while because obviously the impact of the Royal Commission is still being felt by a lot of the banks. You would obviously be seeing all the impact across the equity markets now, and that's impacting their capacity to lend to the various sectors. So I think one of the concerns the RBA might see is if they did cut rates, whether that actually gets passed on to the community and stimulates the housing and stimulates the business sector as well.
Yeah, sure. With the housing market obviously continuing to see this slump, with the banks doing these kind of out-of-cycle interest rate hikes.
Yes.
What does that mean, do you think, for this housing market? I know there's been a lot of big houses predicting a further slump in prices for the remainder of the year. What does it mean with the banks sort of hiking out of cycle?
Well, that's exactly right.
For housing, yeah.
Yeah, it's a real concern, I'm sure, for the Reserve Bank because what they really don't want to see, which will bring pressure on them to lower rates potentially quicker than they want to, they don't want to see that wealth effect really drop down.
Yes.
What was, as I said, the real breather for them is the fact that employment is still pretty good, despite there being some underemployment in this country, of course. Yeah. Employment is still good. So whilst people have jobs, they can still, hopefully, touch wood, afford the mortgages. But, what the real concern, I suppose, for the Reserve Bank will be is that as that employment level starts to change, and if we start to see unemployment coming back to the market, if SMEs can't grow as quickly as they'd like and that engine of the economy starts to slow, that is going to have a negative impact or a further impact on housing, causing it to go down. And as we've seen previously, when that wealth effect in Australia starts to get damaged, it completely changes all people's spending patterns. It goes through the bank's profitability, it goes through the corporate activity, and that then drags the economy down.
All right, excellent. Tony, look, I think we'll wrap up the conversation there. Really appreciate you joining us this afternoon.
Thanks,
Thank you so much.
Cheers.
Tony Sacre, their CEO of the Bentleys Network, joining us.